So you enter into a trade and that trade starts to go in your direction. It starts to make you money. The position is profitable and it's moving up. It's moving up. You're feeling good about yourself. You're seeing that P&L, that green number continue higher and higher. And at some point you decide, I'm going to take profits on this position. So you close the position. You're happy with the amount of money that you made, but you check in a few hours and you see that that position that you were in goes up another 20%, another 50%, even another 100%. And you're asking yourself, why did I exit this position too early? You were happy before that you made money, and now you're miserable because you know you left thousands of dollars on the table by exiting that position too early. And this unfortunately happens to so many traders. This is a very common issue with exiting the trades too early. And the purpose of this video is to equip you with 2 strategies to make sure this never happens again. And the reason it's happening to you in the first place is because you don't have an in-trade management plan. What that means is you might have a plan for entering into that trade. You might have specific criteria that you look for in a winning trade. However, you don't have a plan on how to manage the position when you're within that trade. When are you taking profits? Are you raising your stop loss? How much profits are you taking? All of these questions need to be predetermined. You should know exactly how you're going to manage every single trade before you even take the trade in the first place. And the reason you're not able to do this is because you don't know the strategies that I'm about to teach you. So let's not waste any time. Let's get right into the charts. Okay, so here is the situation on the charts. You decided to trade this base breakout, which is a breakout out of a consolidation, right? So the entry would be over the highs of the consolidation. If you watched my other videos, you know that this is one of the main strategies that I trade, a base breakout. So let's say you trade it, you get into the trade and it starts to move in your direction and you don't take profits up here, right? And let's say this trade begins to pull back, all right? So let's say it does something along these lines where it begins to pull back, and after the pullback, it begins to rally again. Okay, if you're in this situation, one thing that you could do is raise your stop loss to a major pivot, or specifically a new major pivot. So for a consolidation, for a base breakout, our stop loss is always under the lows of the consolidation, right? So let me write that, stop loss. This is your stop loss, original stop loss, okay? Now it starts to move up. You don't take profits up here. It starts to pull back. You're thinking to yourself, okay, it's pulling back. I'm sure it's gonna continue higher. I'm gonna wait it out. Cool. All of a sudden, it does begin to move back up. What you can do here is raise your stop loss from this original point to below this major pivot. Okay, so let me go ahead and get an arrow in here just so you guys could see that. All right, so you'll raise your stop loss to this new stop loss. All right, let's write that, new stop loss. And the reason we're placing it here is because we pulled back and then we rallied. This is a pivot. A pivot is when you have a move down and then a move up. This point becomes a pivot. And you could use pivots as very good stop loss points. And that's exactly what you're doing here. You're raising it to this new pivot. Now, as this continues higher, right, let's say it continues to make new highs, okay? And let's say it begins to pull back again, okay? So you get another pullback. And let's say you're not taking profits up here yet. You wait for another pullback. All right, let's make this a bit more realistic. Pull this over here. What you could do one more time is, again, raise it to the next major pivot point. And then you'll raise it again. This would be your new stop loss. And you continuously raise your stop loss to this new pivot point. This is one option that you have for managing the position. You're essentially, what you're doing is called trailing the position. You are continuously raising your stop loss. So whenever I say trailing your position, all that means is you're going to be raising your stop loss. And you can continue doing this within the uptrend. And by doing this, you're giving it room to fluctuate, to pull back in efforts to capture a much bigger move, right? You're okay with this pulling back and it potentially giving back some profits in efforts to capture the next big move higher and to really go for really good gains. Let me show you another thing that you can do in case you don't get a major pivot, such as something like this or something like this. Let's say you get a move up, and let's say all of a sudden it begins to consolidate. Okay, so it begins to, let's say, consolidate at the highs here. All right, so let me draw this real fast. It begins to consolidate at the highs. What you could do is wait for this breakout out of the consolidation. So let's say it begins to break out, and then once again move your stop loss from this major pivot point to now below the lows of this consolidation. And what you're essentially doing is by continually raising your stop loss, this is, of course, called trailing the position. You're allowing the position a little bit of room in case it wants to pull back, right? Because prices don't just go infinitely higher right away. They don't just move up continuously. They're going to move up, down. So you're giving that asset, the stock, crypto, forex pair, whatever you're trading, the ability to move down a little bit while not exiting the position. So you're giving it the ability to move down and giving it room to then continue higher in efforts to get a much bigger, profit on the position. So these are the different ways that you could trail it. You could wait for a pivot, right? You get a move up, pull back, raise your stop loss to that new low of the pullback, right? Rally, pullback, again, new stop loss would be, of course, below the lows of that pullback. You get a consolidation, raise your stop loss to the lows of that consolidation. And by doing this, you're securing profit while giving it the opportunity to continue higher. Because guess what? Let's say you took profits here, right? Let's say you would make, 20% here, just as an example. You take your 20%, right? Or you give it that little bit of extra room, allow it to pull back, raise your stop loss, and then maybe who knows, you end up taking profits up here or up here. And by that point, you're making 30, 40%. And this is why it's so advantageous to use some sort of in-trade management, such as this one, where you're continuously raising your stop loss to either a pivot low or a consolidation low. Now, the risk of doing this, let me sort of discuss the risk here. Let me just delete all of this stuff right here first. Let's say this stuff never happened. All right, I'm going to delete that just for a second. Bear with me. There's also a risk for trailing the position. And this is why you need a balance in your trading management plan. It's going to make a lot more sense in just a second here. But what could happen is you decide you're not going to take profits up here. Instead, you're going to allow it to pull back, and then you're going to look for an opportunity to raise your stop loss to the pivot low, to the low of the pullback. But what could happen is that you don't take profits up here, and then this continues to drop, right? And then this continues to drop, and it ends up going back to your entry price. Or maybe it even goes back and hits your stop loss price. And in that case, you're probably going to feel pretty bad. You're thinking to yourself, hey, I could have captured 20% profits here. I could have just taken profits, but instead I gave it room to pull back, and it ended up pulling back all the way to my entry price or my stop loss price. And at that point, you're thinking, why didn't I just take profits, right? So you need to have a balance. You need to know, at what percentage gain or at what reward to risk gain am I going to just take profits straight up, or I'm going to allow it to pull back a little bit and then raise my stop loss. Like maybe you only like to go for 3-to-1 reward to risk, meaning if you're risking $100 per trade, you want to be making at least 300. And let's say at this point, it's only up 2-to-1. It's only up $200, right? And let me put a dollar sign. And you're thinking, okay, it's up 2-to-1. I want 3-to-1 on my trade. I'm going to let it pull back, right? And in that case, that's valid, right? If you only want to go for at least 3 to 1. Or let's say this is actually does hit 3 to 1, this is $300, and at that point, maybe you take half of the trade here. Maybe you take 50% of profits, or maybe you just take the entire position outright. You don't even give it the opportunity to pull back in the first place. You don't care about the larger move. You just want to take your 3 to 1 profits and move on. So everything that I'm describing here, you need to think for yourself, right? Like all of our management plans, every trader's management plan is going to be different depending on what suits their style of trading. Maybe you just want to take profits on this first move. Other traders are going to want to go for 50, 60, 70% moves, or 8, 9 to 1 reward to risk, right? So it depends on you. So this is one strategy you could do: raise to a major pivot, or raise your stop loss to a below the lows of a consolidation like I just drew. But there's also another strategy that you can implement, and this honestly is probably my favorite personally. So let me kind of show you how it works. So of course you have your original stop loss and you have your original entry point. Very good. Now let's say this continues higher, it's going up, right? And let's say you're even getting, it's continuing higher in your direction. What you can do from here is something called bar by bar management, where you are essentially raising your stop loss from your original point to under the lows of the last candlestick that was formed. So what that means is, let's say this candlestick was just formed and now this one is starting to form, right? This is in the beginning of its formation. What you can do is raise your stop loss from your original point to the lows of this candlestick. So you place it right under the lows. This is called bar by bar management. And what you're essentially doing is you're basically giving it the room to drop a little bit. As long as it doesn't take out the lows of this candlestick, you're still in the trade, right? So you're giving it the opportunity to, let's say, drop a little bit. Let's say it doesn't take out the lows, right? And then, but maybe on the next candlestick, it ends up taking out the highs and it continues higher. You're still in the trade. Cool. Now let's say this candlestick starts forming, right? That one finishes forming, and then this one begins. Boom. Once this one finishes forming, you raise your stop loss again, and you continue to do that. Let's say this one starts to form. Boom. You raise it again, and you go bar by bar management. And by doing this is probably tighter management than the waiting for the retracement, right? You're not allowing it to go that much against you before you exit the trade. But by doing this, you're giving the trade room to fluctuate, right? While still being in the trade and going for bigger profits, all right? So this is a really, really great way to manage your position, and just by continuously raising your stop loss. And I think the first thought that should be in your mind right off the bat is, okay, that's cool. It seems pretty simple. All we have to do is continuously raise our stop loss from bar to bar, or from the lows of the bar to the next lowest bar, or bar's low, whatever. However, what time frame do I do this on? And that is the most difficult part about it. We have a lot of time frames to decide from, right? Depending on which time frame you choose could be the difference whether you're still in that trade, right, and you're making a lot of money, or whether you exited that trade way too early and you missed out on a bunch of profits. So the time frame that you decide to use is going to have massive implications on this bar to bar approach. Now, what I would recommend is, if you want to have looser management, what that means is you're okay with giving back more profits in efforts to capture a bigger move, then, and I want you guys to maybe think about it for a sec, what time frame would you want to use? Would you want to use a higher time frame or a lower time frame? Pause the video and think about that. And the answer is a higher time frame. With a higher time frame, these candlesticks are likely to be bigger, right? If you have a bigger candlestick, right, like let's say right here, let's say your stop loss is under this candlestick, and this is a pretty big candlestick. That means you would be giving it all the way down here. You would be giving this trade room until here for it to potentially fluctuate, right? So the larger time frames that are going to have larger candlesticks, as a result, it would give more room for it to fluctuate in efforts that it will continue higher. but you're also going to give back more profits if it does hit this new stop loss, right? Like imagine you're up here, you're making really good profits, and all of a sudden it starts to pull back randomly and it hits your stop loss down here. You're giving back all the profits you made from this point all the way down, right? You're giving back quite a lot of profits. So larger time frame is looser management in efforts to get a bigger gain, but you're okay with giving back profits. Tighter management would be using a smaller time frame, okay? So let's say, for example, let me delete this. I'm gonna make it a bit easier for us to understand this, okay? A little bit easier for us to understand. Let's say this is where we're at currently, like right here, right? Let's say this is like the, I don't know, 15-minute chart, okay? Just as an example. And let's say this is like the 1-minute chart, okay? Cool. So in this candlestick, right? Actually, no, let's make it a bit easier for us. Let's make this a 5-minute chart, okay? Within this 15-minute candlestick, you're gonna have 3 5-minute candlesticks. So let's say these are the 3 5-minute candlesticks that you have. Okay, this is going to make it really easy for you guys to understand. All right, so let me recap that one more time. Right, we're looking at this candlestick. This is one 15-minute candlestick. In a 15-minute candlestick, you're going to have 3 5-minute candlesticks because this is 5, 5, 5. This makes up 15 minutes. Okay, now as you can see, if you're going 15-minute bar by bar management, your stop loss would be here. If you're going 5-minute bar by bar management, your stop loss would originally start here, then it would move to this 5-minute bars low, then it would move to this 5-minute bars low. And you have a tighter management, right? Because instead of having your stop loss set here on the 15-minute chart, you actually have your stop loss set here. As you can see, you're taking profits quicker. It's tighter management. You're not giving the trade that much room to fluctuate. Okay, so maybe you want to secure profits quickly, right? You don't want to give it that much room in efforts to get a bigger gain. You want to secure profits quicker. You would go with a smaller time frame and you would do bar by bar analysis, bar by bar management on the smaller time frame. You can even go to a 1-minute time frame and do even smaller, even tighter management. So it's up to you. It depends on you. It depends on how much room you want to give it. Are you okay with doing looser management, but you might give back more profits, but then you also might make more money? Or do you want to do tighter management where you're definitely going to secure the profits that you want, but you're not giving the trade that much room to fluctuate to go for that bigger gain? Hopefully this is all making sense. I know I'm dropping a lot of information on you guys right now, but hopefully this makes sense. So you have to pick which time frame you want to do bar by bar analysis. And even this also, everything I described here also applies to the first strategy that we learned in raising it to a major pivot point, right? You could have, let's say if you're looking at the 15-minute chart, maybe on the 1-minute chart, it is pulling back, right? So you might have to go to the 1-minute chart and raise your stop loss to a major pivot that's on the 1-minute chart that wouldn't be on the 15, right? So everything that I just described, this is also going to apply for the first strategy that we learned in terms of raising your stop loss to a new pivot point, okay? Hopefully this makes sense. One more thing that I wanted to mention as well is, let's say you get a huge move up, right? And you're managing the position. If you get a huge move up like this, let's say on the 15-minute chart, right? Your stop loss is down here. You are giving back way too much profits if this was to move down and hit your stop loss. Way too much profits. You don't want to do that. In this case, go to a smaller time frame. If this is the 15-minute bar, go to the 1-minute chart and trail your position 1-minute bar by bar, right? Like let's say on the 1-minute, this is what's happening, and it's moving up like this, right? And this is where it's at. It's up here. Then, instead of having your stop loss down here going 15-minute bar by bar management, go 1-minute bar by bar management, right? Okay, in this case, you're securing profits much more tightly. You have a tighter management. You're going to be securing profits much quicker as opposed if you left your stop loss down here. So if you get a big move up, go to the smaller time frames and manage from there. Cool. This is essentially the 2 strategies that I use in terms of managing all of my trades. Okay, I either raise my stop loss to a major pivot point or do bar by bar analysis, bar by bar management. Hopefully this all makes sense. Let me know if you guys have any questions, and make sure you are registered for my free price action class this Thursday at 6 p.m. Eastern. You could register in one of the YouTube links below. Make sure you're in the class. I'm going to be answering questions live at the end of the class, so make sure you stick around. And of course, make sure you follow up on my Instagram. Make sure you subscribe to this channel. Watch all of my videos. I'm dropping a lot of trading education, a lot of trading sauce. So make sure you take advantage. But yeah, I will see you in the class. And if you do register, type in the comments of this YouTube video, hey, I registered, looking forward to see you. I'm gonna like your message. I'll remember your face. I'll remember your name. It'll be, nice to see you in the class. So hopefully you learned a lot. I'll see you guys on the next video.